Imagine walking into a bank that never closes, has no loan officer, and does not care about your credit score. Instead, a piece of software decides everything based on math and collateral. That is Aave, one of the largest lending and borrowing platforms in all of crypto. Let us break down what Aave actually is, how it works, and why it matters. Aave is a decentralized finance protocol, or DeFi protocol, that lets people lend and borrow cryptocurrency without a bank or middleman. It runs on blockchain networks like Ethereum, and the whole system is powered by smart contracts, which are self-executing pieces of code that handle everything automatically. The name Aave actually comes from the Finnish word for ghost. The founders chose that name to represent transparency, since everything on the platform is visible on the blockchain for anyone to check. Aave launched in 2017 under a different name, ETH and rebranded to Aave in 2020. Since then, it has grown into one of the biggest players in decentralized finance, often holding tens of billions of dollars in total value locked, which is the amount of crypto deposited into the platform. Today, Aave runs across multiple blockchain networks, not just Ethereum, including Polygon, Avalanche, and Arbitrum. This lets users lend and borrow with lower fees and faster transactions, depending on which network they choose. Here is the simple version. Say you own some Ethereum and you are not planning to sell it anytime soon. Instead of letting it sit in your wallet doing nothing, you can deposit it into Aave. Once it is in the protocol, other users can borrow against it and you earn interest in return. On the other side, if you need cash but do not want to sell your crypto, you can use it as collateral and borrow different assets like a stablecoin against it. You pay interest on what you borrow, and that interest is what pays the lenders on the other side. This creates a marketplace of lenders and borrowers, but instead of a bank managing the risk, smart contracts do it automatically. Here's a quick example. Sarah deposits $10,000 worth of Ethereum into Aave and starts earning interest right away. Mike wants to borrow against his Bitcoin without selling it, so he deposits it as collateral and borrows a stablecoin from the pool Sarah contributed to. Mike pays interest, and that interest flows back to lenders like Sarah. Neither of them ever met, signed paperwork, or got approved by a loan officer. The smart contract handled it all. One of the most important concepts to understand with Aave and DeFi lending in general is overcollateralization. Since there is no credit check and no way to verify who you are, the system protects itself by requiring borrowers to deposit more value than they are borrowing. For example, you might need to deposit $150 worth of crypto just to borrow $100 worth of another asset. If your collateral drops too much in value, the protocol automatically liquidates it, selling it off to repay the loan and protect the lenders. Unlike a bank, which trusts your credit history, DeFi trusts only the math. Aave also tracks something called a health factor, which works like a fuel gauge for your loan. As long as it stays above a certain threshold, you are safe. But if your collateral value drops or your borrowed amount grows too much, that number drops too, and once it crosses the danger line, liquidation kicks in automatically. Aave uses a dynamic interest rate model, meaning rates are not fixed. They shift based on supply and demand for each asset. High borrowing demand with low supply pushes rates up to attract more lenders, while high supply and low demand push rates down. Aave also offers both variable and stable rate borrowing, giving users flexibility depending on whether they want predictable payments or rates that move with the market. One of Aave's most unique features is the flash loan, a loan that requires no collateral at all, with one catch. It has to be borrowed and repaid within a single blockchain transaction, all in seconds. That might sound pointless, but it is a powerful tool for developers and traders doing things like arbitrage or refinancing debt across platforms. If the loan is not repaid by the end of that transaction, the whole transaction cancels automatically as if it never happened, which makes flash loans risk-free for the protocol. Aave also has its own native token, also called Aave. Holders can use it to vote on changes to the protocol, since Aave is governed by its community rather than a single company, structured as a DAO or decentralized autonomous organization. Token holders can also stake AAVE in the safety module, which acts like an insurance fund. If something goes wrong in the protocol, staked tokens can cover the gap, and stakers earn rewards for taking on that risk. There are a few main reasons people turn to Aave instead of traditional finance. First, access, since anyone with a crypto wallet can use it, no bank approval needed. Second, speed, since loans can be issued in seconds instead of days or weeks. Third, transparency, since every transaction is visible on the blockchain with no hidden fine print. It also lets crypto holders unlock liquidity without selling their assets, useful for tax reasons or simply because they believe their crypto will be worth more later. Of course, no financial product is without risk, and Aave is no exception. Smart contract risk is real. Even though the code is heavily audited, bugs or exploits are always possible in DeFi. Liquidation risk matters too. If the market moves fast and your collateral drops in value, you could get liquidated and lose part of your deposited crypto. Crypto markets are volatile, so interest rates and asset values can shift quickly. Aave represents one of the clearest examples of what decentralized finance is trying to build. A financial system that runs on code instead of institutions, where access is open to anyone, and trust is placed in transparent, automated rules instead of a middleman. Whether or not it replaces traditional banking, it has already proven that lending and borrowing can work in a completely new way. This is not financial advice, just financial education. Always do your own research before making any investment decisions. If you found this helpful, make sure to like, subscribe, and turn on notifications so you do not miss the next breakdown. See you in the next video.